What up, what up, what up? It's Bruce Rochester with a quick video. In this video, I want to talk a lot about risk reward, okay? And I feel this is very important because if you guys can understand risk and more focus on not the reward, you're going to be very, very, very profitable in trading. A lot of times people get into the trading and they want to basically get to the home runs quick. They want to get to making $500 to $1,000 real fast overnight. And this is not an overnight process. This is a way of building long-term wealth, having longevity income, having this coming to you forever. So if you want this to be that long-lasting income that's going to pay you over and over for the rest of your life, you need to treat this serious and you need to respect money, because if you don't respect the market won't respect you. All right, so this is the Trader's Way brokerage account, where you can log in. Uh, Hopefully everyone has their account, whether you have a live account and a demo account. Now, this is just one of my newest business partner, his back office. You can have your demo account open here, and you have your live account. Now, everyone who is part of the company and who's part of this, always make sure this is where you're going to do your withdrawal. So when you're ready to take money out, you click right here. This is where you're able to, take out money. You simply click here, and you can transfer the money right back to your debit card. This is the option I use. It only takes like 5 to 7 business days for it to be transferred back to your card, and that's just your one of the many methods of transferring money. Now, when you're ready to deposit money, you click deposit, and that's the next method of operation where you can use to transfer money. Okay. Next, I want to talk about is leverage. What does leverage mean? Leverage really means what your risk, what basically they're going to allow you to take a risk. The higher your leverage, the more risk you take, which is good and there's bad, because in the long term, brokers and the market makers, they want you to take higher risks. They want you to be in a position where you take a huge amount of risk, because in the end, people who usually take high risks get a high reward, but in the long term, you won't be that person who's making a consistent amount of money. So I always recommend, if you're starting off and you're new to trading, your leverage should be 1 to 100 or 50 to 1, which is 1 to 50. Sorry, 1 to 50 or 1 to 100. You shouldn't be taking high risk, because when you have a lower leverage, this is going to prevent you from a person who can't control what they can't control, which is going to lead them to be out of control and put them in a state of anxiety. And which most of you guys have a hard time controlling is your emotions. And you're going to take high risks that you shouldn't be taking. So make sure your volume or your leverage is set to either 1 to 100 or 1 to 50, okay? And if you have, $5,000 in your account, this will prevent you from ever blowing your account, because the method you should be doing is, when you're trading, you should always be going for, I would say, more of a reward and less of a risk. And what I talk about that is, I'm going to talk a little bit about that in a little bit. Now, let's say, for an example, this is what most traders, make a mistake on. They always focus on the reward and not the risk. So your risk-reward ratio should always be 2 to 1 or more. All right, should be 2 to 1, which means your reward should be more than your risk. So there's a trade. I'm going to go over that right now. All right, give me a second. All right, there was a trade that we had recently last week, okay? And I'm going to talk about what the risk and the reward was, all right? So let's look at CHF, which stands for the Swiss dollar, versus the JPY, okay? JPY, right? Um, it was a buy stop order, right? It was a buy stop order, and the price we were buying it at was 118.50. Now, when you put the price in, always remember there's going to be a zero at the end. So this is what the price says, but just remember there's always going to be another zero, okay? So that was the price we bought it at. And so I'll type in price. All right? And the stop loss, was 117.77. All right? So this is how I do my math. If I'm buying it at 118.50, don't forget I always add another zero right here. The stop loss is at 117.77. Then I put the zero at the end. So what I do is I just go like this. This is going to tell me how many pips, which is percentage on points. That's what the word pip stands for, percentage in points. And hopefully you watched the basic training video on pips. So you do 118. Oh, let me bring out the calculator. So you go 118.500 minus the stop loss, which is 117.770. I'm risking 73 pips. So 73 pips is what I'm risking, all right? And if you want to know what if you're risking too much money, then what you do is you could just easily 73 pips really means 730 points. So anytime you get 73 pips, you just put a zero on it, which means 730 points. If it was 55 pips, then it would be 550 points. If it was 10 pips, you add a zero to it, that's 100 points. So remember, the word pip means percentage in points. So since it was 73, you do 700, you add the zero, 730, and you times that by your lot size. Now let's just say your lot size was set for 0.25. Now you do, if you did that, let's do the math. Let's do the math here. So let's just say you're risking 73 pips, which is 730 points, times your volume, your lot size, and your lot size is your volume. And if you don't know what your lot size is, it's that number that's in the middle that's under market execution. So if your lot size is set for 0.25, let's get the calculator out. 730 times 0.25, that equals $182. That's what you're risking, $182. So if you're risking 73 pips, right, at 25 cents, right, and you're risking $182, and you have a $1,000 account, you're basically risking 18% of your account. If you have $200 and you're risking 25 cents, you're risking more than 80% of your account. Do you think that's good risk management? No, it's not. So let's now say your lot size is now for 0.01. Now that same 730 points times 0.01 is $7 you're risking now. I mean, I'm pretty sure you guys can easily do the math, but if you want me to type it out for you, 73 pips, so you add the zero, so which is 730 points, times your lot size, 0.01 equals $7.30. Now, if you have $100 and you're risking $7.30, that's 7% of your account. Okay? I think 7% of your account is pretty reasonable, right? Do not focus on the reward, guys. I want you to focus on the risk. So anytime you get a price, you minus that by the stop loss, which is going to get you the pips that you're risking. And then you times that by your lot size, and you get the dollar amount on what you're risking. Now, if you can focus more on that and not the reward, I mean, you're going to win trades regardless, but you need to focus on this part here. Do not focus on going over that, right? Because the reward is going to come. You have to focus more on the risk, all right? So that's more important than reward. Rewards are always going to come. And think about it. Even if you're doing 0.01, let's just say, now let's look at the reward. The reward was the take profit. So the take profit was take profit. The take profit numbers were, which is the target area where we're going to get out. Give me a second. Let me go back to the CHFJPY. Take profit was 119.87. So you add a 0 to it. So let's just do the math on how much the take profit is. We're risking 73 pips. Let's see how much the reward is. So we're buying it at 118.500. Actually, you do it like this. You do the bigger number. 119.870 minus 118.500. And that gives you 1.37, right? So that 1.37 is really 137 pips. So 137 pips. So our risk is 73. Risk is 73 pips. That's risk. And the reward is 137. So if you do 137 pips, if you add the 0 times your lot size, it's even if you lost this trade and you win 1, it's gonna cover more than what what you're losing is, because you could lose 1 but win 1 trade, which will cover your losses and always keep you in profit. So your reward, let's just say you're doing 0.01, that's $13.70. So you're looking to lose $7, but you're looking to gain $13. All right? Slow grind it, guys. Don't put big lot sizes because you want to make all this money fast. Now, if you did a 0. Now let's just say you're doing 10 cents. So you do 10 cents, 10 cents on 137 pips, right? No. Let's focus on the 700. Let's look at what we're gonna lose if we did set 10 cents. So that would be just to make sure you guys see that I'm doing it right. So you do 730 times 0.10. All right, that's $73. $73 on a $1,000 account. That's about 7%. All right, you can risk that kind of risk on a $1,000 account. On a $500 account, it's too much. On anything, if it's not $1,000 or more, you shouldn't be doing 10 cents. Put it that way, okay? All right, you should not be doing 10-cent lot sizes if you don't have $1,000 or more, because if you lose $73 on anything, you're risking more than 10% of your account. You're risking 13, 15, 20% of your account. That is not good money management. And in the long term, you're going to lose rather than you're going to win. And if you want to win in the game, you need to keep your losses low and your wins high. Hopefully that makes a lot of sense, all right? And the only way you can control your emotions, make sure your leverage is set to 1 to 100. If you have $10,000 in your account, make sure you set your leverage to 50 to 1. Now, here's a scam that a lot of brokers like to do, and I call it a scam because to me it's so tricky in how they do it. A lot of brokers give out this thing called a bonus, right? And that bonus allows you to do more leverage. But the money that you're risking, let's just say you're now doing bigger leverage, right? So it's now allowing me to do 15 cents, right? But if I lose the trade, I'm not losing the credit, the money that they credited me, which is not real money. It's kind of like monopoly money. I'm really losing my real balance. So let's just say I lost, $200 on that trade because they gave me this humongous bonus of $5,000 more, which allowed me to do more risk, but it's really increasing my risk, and that's not good because in the long term you're going to lose more money. So brokers want you to take more risk. They want you to have these bonuses so you can have a higher lot size, because the higher you do your lot size, the higher the risk is, and the higher your risk is, they know in the long term you're going to lose because you're just so emotionally greedy that you want to make all this money overnight. So to control your emotions, forget the bonus. Don't add the bonus. Do without the bonus. And I'm telling you, you're going to be more profitable because the bonus is going to trick you to thinking that, hey, I can now take more risks. But remember, you're risking your real balance, not the credit balance. The credit balance isn't real money. It's fake money to induce you to take higher risks. And since they want you to induce you to take higher risks, in the long term, you're not going to win, guys. You do not want to do that. So do not ask for a bonus. Do not fall into their trap. Stick with whatever you have in your account. Stick with doing the small lot sizes. Stick with knowing how much you're looking to lose. And I guarantee you and I promise you, if you focus on what you're looking to lose, you'll always stay in profit, forever in profit, and you'll always continuously be a profitable trader, and nobody can tell you anything. So always make sure your risk reward ratio is high, and you'll always stay in profit. Hopefully this video helped you out on risk reward, because I feel it's very important to focus on that. And as long as you focus on risk reward, you'll always stay in profit. If you don't know what a lot size is, please go back to video 1, and it will talk to you about what your lot size is. And if you understand what a pip is, that video 1 talks about that. But this video is specifically showing you how to do the math on how much you're risking, and how much you can do the math yourself by saying, are you going over a certain percentage. My suggestion, you shouldn't be risking more than 5% of your account. I mean, if you are a little risky and you want to risk 6 or 7%, that's cool, but you shouldn't be risking more than 5% of your account. All your trades should be anywhere between 1 to 5%. Some people are even more conservative and they don't want to risk more than 3%. So if you're that kind of guy, then, or that kind of woman or gal, that's fine, but I suggest do not risk no more than 3 to 5%. And if you want to do the math, like I said, all you have to do is you take the price that you're buying it at, right? You can look at the price, you add a 0, and you just minus the price minus the stop loss. And that's going to give you that number here. So we got 118.50 minus 117.77, and that gave me 0.73, which is 73 pips. You're risking 73 pips, and 73 pips is really 730 points. All I did was add a 0. Points. Remember, pips is percentage in points. So if you want to get the points, just add the 0. It's 730 points. You times the points times your lot size, and that tells you how much money you're risking. Then you look at how much money you're risking by your balance, and that would give you the percentage of how much you're risking in your account. Hopefully that makes sense to you guys. And if you can focus on that, you'll always be in profit. This video is now 20 minutes long. I don't want to get any longer than that. Thanks for watching. If you have any additional questions on risk reward, you can shoot me a question on Facebook. My name is Bruce Lee Rochester, and I'll see you guys at the top or from the top. Peace.